Let's talk restaurants and casual dining and coffee. Okay, so we're talking eating on Hot Picks today, and we're starting off with McDonald's. Our guest has that as a top selection. He expects it will post a strong fourth quarter by offering new menu items. We're joined by Jon Tower, equity research analyst at Citi. Thank you very much indeed for joining us.
Hey, thanks for having me, Andy. Hope you're doing well.
I am indeed. So I'm looking at McDonald's obviously a reliable blue chip for many investors. Stock up a total return of about 47% in the past 5 years, lagging the S&P 500 a bit. But you see promise here, in particular, a new emphasis on chicken. How will that help them?
Yeah, look, their chicken menu relative to the competitive set, I would argue, has been somewhat bland. You know, they introduced the spicy chicken sandwich a few years back. It worked out relatively well. This most recent year, 2025, they added chicken strips. You've seen it show up in their snack wraps. It's been an okay product. I don't think it's been the home run product that they were looking for. I think what you're going to see in 2026, perhaps later in the year versus earlier in the year, is more innovation around grilled chicken, probably an upgrade on even the strips that they have, potentially moving to some of the tenders. They did have those selects back in the day that worked out very well for them. And I think you're going to see more by way of flavor on the actual, toppings for the chicken. And look, in test markets across the US, they are testing wings. I don't know if that's going to make its way finally to the menu. We did see it back in 2013, I believe. It was an LTO, limited time offer. Could it come back? Maybe. I think actually more interestingly, they're getting more aggressive in beverage. And I would not be surprised on this earnings call, which will be coming up in about a week, if we hear more color on timing around potentially getting on a more robust beverage platform. So think, expanded coffee platform, more importantly, refreshers and energy. That's likely something we'll see sometime earlier in 2026. When you could think about taking a step back about the company, prior to the past year and a half or 2 years or so, this company didn't really have its marketing and product innovation muscle in place the way that it does today. They had spent really from 2016 through the early parts of COVID working through the Experience of the Future remodels in the US. So they spent a lot of energy and capital on that, which was kind of refreshing the asset base. And it came at the expense of a lot of this product innovation and marketing, not to a massive degree, but to enough. And I think what's happened and what we're seeing, and even the message from the company in the past 12 months is, hey, we've found some mojo here. We're putting a lot more energy towards this. And we understand that getting new products at a higher velocity across the system with better messaging is going to drive more traffic to our stores. And that likely means you're going to see much more consistent same-store sales and traffic growth from the brand, particularly in the US, but even globally starting this year.
It's interesting on beverages. They might be going towards these so-called functional beverages or energy drinks. And because the margins on beverages tend to be huge, don't they?
Yeah, they're better than, say your chicken sandwich or so. I think operators, particularly franchisees, look at this from a penny profit standpoint. They can still make some pretty good penny profits off of these platforms. But I also think what it does for them is it opens up day parts where perhaps today they're either under indexing versus some of the competitive set, or, it adds a nice check lift to different parts of the day. Say breakfast, for example. If someone was coming in getting a hot coffee, now you've got potentially a more robust menu where you can upgrade $1 or $2 to get some of these cold beverages and energy drink. So it does widen out who they're speaking to and likely drives greater frequency to the business going forward.
Let's move on. Dutch Brothers, they have beaten the pants off Starbucks over the past 5 years, although I notice the stock is down from its high.
Yeah, so the stock's been under pressure year to date. I think there's a few things going on. In particular, it's been a name that a lot of folks like on the buy side and the sell side. I think that over ownership to start the year has been a bit to the stock's detriment. I do not believe that they're having weakness, particularly in their business outside of weather, like the whole industry is having. The other bigger fear, I think, that's been permeating throughout the marketplace has been around competition, right? We heard from Starbucks last week say that they're expanding some of their beverages, they're getting into energy. McDonald's, as we just spoke about, is getting more robust in the energy platform. But taking a step back, we can actually look in the marketplace as an example for what can transpire for smaller brands when they're positioned well, when a bigger entity comes in and starts marketing value. And that is, you look at McDonald's at that 2010, 2012 timeframe when they got more aggressive on coffee, premiumized it. It actually helped out Starbucks quite a bit in the US, who was growing like a weed at the time. I think that's what's going to happen here with Dutch Brothers. You'll see these other brands marketing it. And I think what consumers will do, particularly younger consumers, they're going to go back to the brands that they love and that they're being spoken to. And they're going to go to the brands that have customizable energy and a much more robust menu in a convenient fashion. And I think Dutch Brothers is going to ultimately benefit from this wave of competition coming into the category.
And just finally, we're tight for time. I'm sorry, but Chipotle Mexican Grill, that stock has been a disappointment for investors. But you see the prospects for a turnaround.
Yeah, I think 2026 is going to be a much better year for them. I think you're just going to see a greater velocity of new product news, traffic driving initiatives across the company. And frankly, there's a lot of fear on margins for the company in 2026. I think we're going to hear a better story from them. You know, tonight you're going to get relatively mixed news on the fourth quarter and perhaps because of weather, weaker noise about the quarter to date, but I think they're going to be conservative on their guidance. It's going to be a very good year because you're going to see much more traffic coming back to their stores on the back of better product news and marketing.
Jon, thank you very much indeed. Jon Tower, equity research analyst at Citibank.